Welcome to this week's Q&A. Today is Melbourne Cup Day in Australia, the horse race that stops the nation, as they say. And it's relevant because it's also the day that the RBA board meets. In fact, they've just met and they've raised the official cash rate by 25 basis points to 4.35%. Now, it's the 13th rise in this current cycle of monetary tightening. But it's more significant because it comes after 4 monthly pauses. So the last 4 months, the Reserve Bank of Australia has left the official cash rate on hold at 4.1%. They've now decided to increase, and this was driven by the latest data that was released in relation to the September quarter, both headline and core inflation above expectations, and then consumer spending numbers came in and they were again surprisingly on the strong side. So data there to support that in some aspects, and many economists anticipated this. But it's relevant because the questions we've been getting at the moment from our Australian expat viewers around the world and from so many of our Australian domestic clients have all been in relation to interest rates, how this is impacting people's investment property loans and their home mortgages, and what they could do to perhaps buy some peace of mind. So this week's questions has come from numerous sources all around the globe, and people are saying, should we be potentially fixing our interest rates again now because we're just unsure of what central banks are going to do going forward? And today's increase is a case in point. But as I always say to people, look, you need to look at these things perhaps a little more clinically, and currently I think we are either near the top or at the top of this current rate hiking cycle. So you're potentially buying this peace of mind insurance that says your interest rate's not going to vary over the next 12 months or 2 years or 3 years or whatever period you decide to fix, but you're paying potentially a lot of money for that. So people don't realise, but other things impact rates. And if we've looked at, or if you've been looking at bond markets over the last couple of weeks, you would have seen that there have been some extraordinary moves there, massive volatility, where long-term, so 10-year government bond yields in the US touched over 5%, in Australia almost at 5%. So, this has been leading to other things behind the scenes, and we've had, say, the ANZ only a week ago raise their fixed interest rates on their suite of loans by 30 to 35 basis points. So, you might be fixing your rate, but you might be doing that at a pretty costly number. So perhaps at the moment, being conservative is a better approach, and you might want to stay on a variable rate and just see what happens, because no one really knows what central banks are going to do in the short to very short term, I suppose, medium situation in relation to rates. So it's best to play a safe hand. And look, it depends on everyone's own situation, but as I always say, look at these things and give yourself some flexibility to act without potentially jumping the gun. Now, if you've found this of interest, then please subscribe to our YouTube channel and click like. And if you need some further information or assistance with this, don't hesitate to reach out, and we'll get somebody to contact you and help you with your own set of affairs. I'm Andrew Unterweger. I hope you picked this year's Melbourne Cup winner, and I'll see you at next week's Q&A.